Hello, everybody. It's Stephanie Larson with Winans Investments. I know it's been a little bit since our last video. Sorry about that. Some of our clients have been asking and very politely nudging, and so I figured I'd do a quick call. We've pretty much made it through earnings season, which makes this a really opportune time to kind of talk about what's been happening over the last quarter and what we're kind of expecting for the remainder of the year. It's been an interesting market to say the least. I think the volatility that really started with the tariffs, so it was really essentially politically motivated, has really dissipated. I would be very careful engaging with the market at this time. Earnings in general seemed very positive. There were not a lot of huge misses, at least not on our platform. One or two. There was actually a lot of upside with them. The leadership rotation that we did at the beginning of the year really seems to have panned out very well for us. And we're not really seeing that change. A lot of kind of industrials, financials, things like that are still doing quite well. I will say Europe has done very, very well. Also, we have a little bit of European exposure, a lot of multinational companies that we are invested in that have done quite well. The strategy that we employ, engaging the risk mitigation protocols earlier on in the year, really rotating, being cautious with cash, has really seemed to work well. The strategy has worked really well this year. We're very proud to see where our portfolios are. I know our Morningstar rankings came back out. We were in the top decile again, which is a huge achievement against our peers. It works, and we're still being quite cautious with our approach. I think any account that has equity in it will have noticed that we're just starting to nibble at the market a little bit. We've made it broadly through earnings. Earnings season, by the way, actually starts a little bit later. Once the quarter ends, a lot of time financials would report within really a week, and now it's much later. The earnings season is really almost a full month after quarter end. You get the heart of it, so you really do have to wait until essentially now the end of the second month of the quarter to kind of really know how things shook out. And even last week we were still having big corporate earnings from some major players in the market. So I think all in all, there's going to be a delay factor with the tariff impacts. I know there's a stay on them. That stay's about to expire. That could make things a little interesting. I know there's a big budget bill trying to go through Congress, and could be interesting, mainly for taxes. There's some tax provisions in there and tax extensions that could affect the corporate side of the world. Obviously, personal is completely different. Along with that, like I said, there wasn't a lot of big earnings surprises, but there is going to be a delay. And what you can see with some of the smaller retail companies, what the leadership said for guidance purposes was, hey, we've burned down essentially all of our inventory and didn't reorder so that we could avoid some of the tariff impacts. Now, with the stay, they might have been really smart and they might have bought really quick just to avoid that. But then if the tariffs are extended, they're going to go through those same kind of cycles of burning down inventory, hoping the environment gets better. And if it doesn't, then they're going to have to start eating costs. So that's kind of the interesting corporate business side that is really kind of going on in the market. It hasn't really impacted us. There's been a real sharp recovery. Like always, bonds lead, and the bonds have sharply V'd. The stock themselves have. It'll be interesting to see how it plays out into the next quarter. Like seasonality-wise, the old, saying of sell in May and go away might not actually be true this year. We're gonna see, because there was so much volatility early in the year. Some of the seasonality might not quite actually hold true. So we are, like I said, starting to nibble at the market. We're not going to be overly aggressive. A couple weeks ago, I would say out of your equity allocation, about 20% or so was in cash. with some flexibility depending on specific accounts for specific reasons. Now I would say it's probably closer to 12. I'd have to look, maybe closer to 10. And we're going to hang tight here, but keep nibbling at the market a little bit. We're comfortable with where we're at. We don't want to be really aggressive. Looking at our research indicators, though, I'd say about 2/3 are green. And that's the kind of thing where you're like, well, it doesn't seem like it wants to make sense. I'm not going to bet against the market. I don't really want to be overly aggressive. We kind of survived earnings, and we're not really sure. Guidance, a lot of times portfolio managers and investors will look at guidance. The problem is with so much uncertainty, specifically with the tariffs, the guidance doesn't really tell you what you would normally want to hear, or I wouldn't count on it the way that I would normally count on the guidance. I would say like, hey, that's going to be pretty accurate. And this time you have to be like, well, is it? I hope so, but I'm not sure. So there's still a fair amount of uncertainty, and everybody knows because we've said it many times, the market hates uncertainty. But for now, it seems to have gone back to its recovered level, and it's kind of just doing this, and I think it's just waiting for more information. And I think the more information is going to come out. Does the Fed increase rates? Does it cut? I think it's more likely that it's going to cut, but not at the next meeting. I think what Powell is waiting for is to really see some of the economic data. And it is softening a little bit. Some of the labor numbers came out a little soft, but nothing crazy. And I think he's just going to continue to wait until he has more information, and then he'll make a decision. So we're really going to see how this plays out. Again, we're not optimistic per se, but not necessarily pessimistic. We're just kind of, we're neutral, I guess would be the best way to say it. So again, it's been an interesting ride. I think this has been one of the more interesting years because it's been a lot of self-inflicted pain on the market. And I think this is one of those years where truly being a technician actually matters the most. Really, you can't just bet on the Magnificent Seven, for example, and you're going to do great. You're really going to have to reevaluate the leadership, really know when stocks are starting to break down, and just cutting losses. And Ken and I just had an investment meeting yesterday, and we all agreed that we're not married to any names. None of these are our chosen favorite that we will never sell. If it really starts to break down and there's confirmation, it's gone. And we were really aggressive at the beginning of the year in doing that. So we really like the names we're in right now. There's only a few that we're really kind of eyeballing, or that are technically on our watch list. And we like the leadership that we chose. So we're just going to continue to do it. We tried a few new names in this last round of buys. We're going to see how those shake out, and we're going to go forward. So the stock side's been interesting. The bond side's been boring. Since our last video, I made it very clear there was a massive dislocation in the bond market. Very interesting treasury auction. Munis took a huge hit. There was a big blow up, essentially, temporarily. But bonds lead in recoveries, and true to form, bonds have recovered. The little window that opened up, that we were like, hey, this is the window where we want to attack, and for new money that had come in, those clients saw me be very aggressive on the bond side, more so than I ever am, and I'm really glad I was, because a bond portfolio that I could have made 6 weeks ago or 8 weeks ago, I cannot buy that. I can't build that now. So I'm very happy with what we did and when we attacked the market. If you go out the risk spectrum just a little bit, in the more B kind of triple C area, you will still see a lot of yield, but we won't load a portfolio with just that. So there's going to be a nice balance. The higher graded bonds are getting really about 6.5 to 7, and that's the best you're going to get on really quality paper. And then if you go out the risk spectrum a little bit, you're going to get closer to 8.5. You can actually get a lot more. Like Mercer, for example, or R.R. Donnelley, you're paying 10%. But I can't buy it. I've been trying to buy R.R. Donnelley all week long, this week and last week. Cannot buy it. I can't, there's no one that's selling it. And it's because the sellers know that it's not worth that for them. And I know that I'm going to get a huge deal if I can get my hands on it. So there's still a few bonds out there that are paying ridiculous amounts, but it's only if you can buy them. Mercer I'm able to buy. I have bought for pretty much everybody, but those are just two examples that I kind of wanted to give. There's also some more unique ones that are really time sensitive. For example, like Xerox. There's a 10-year Xerox bond paying, I think it's like 5.5, but the yield to maturity is over 20%. It's just, do you feel comfortable owning something for 10 years? And that's the grade. But if you are with Xerox, you're going to make 20% on it. So like I said, it's been a real interesting bond market, but right now where we are in the cycle of it, kind of boring. Now I'm really having to dig really deep to try to find higher quality bonds that are still paying over 6.5. And that just means that I'm having to go really slow, and that's fine. I'm happy to do that. But I'm also starting to see on the bond side, calls are picking up. They're picking up quite dramatically. So I think we went from just 2 the other day of our Ally Financial bonds to I have 6 now, and that's just in the span of a week. So I'm hoping that slows down, because that just means that to replace the paper is going to take a lot of effort, and to get where I was, and it's going to be really hard to do. So I'm really hoping the calls stay down. It's not a big deal. The other thing is that preferreds are still priced very well yield wise. So I'm going to be doing a big round of preferred buys for everybody. If you need fixed income and you're a little light on preferreds, I'm going to be putting them into your account, if not tomorrow first thing, then the day after. So that's kind of the plan. There's always supplemental ways that you can add yield to a portfolio. In this case, preferreds are still doing quite well, and that's probably what we're going to be until the bond market loosens up a little bit more. And I think it will. I really do. So it's just time. Tea break. So just a couple things. This has already gone a little long. Sorry about that. But I really did want to touch base and let everybody know what we're seeing and what's going on in the market and et cetera. A couple housekeeping items. Your overviews you should have received long ago. If you did not get that, let us know. Ken is actually going to be in the Bay Area. He'll be in Marin in July. We're sending out invitations to all of the local clients around here if they would like to come up to a client appreciation thing, or if you would like to just schedule a meeting with Ken. He'll be up here for a few days and can absolutely do that. So just reach out to either Alana or Amy, and they'll get you on his calendar for sure. And then I know temporarily right now, the Vegas office phone number is having some issues. It's due to the office building. It's not due to us. So if you're having a hard time reaching the Vegas office, please just call the Marin one. It's the same number as always, or just email, and someone will get back to you immediately. I just want to make sure that there's not any calls that are being missed for any reason, and someone needs something that's a priority, and they're like, I can't reach you. So anyways, I will make sure for the next video, Ken will be on that. He does say hi. He's currently writing a Forbes article, which is why he couldn't be on the call today or on the video today. And we'll make sure that we're on together. But we talk every day like normal. We're keeping an eye on the market like normal. We're very happy with where we are and how we're performing. And we're just going to stay the course. You'll see the activity in your accounts like usual. And if you need anything at any time, please reach out to any of us. We're always here for you. And we want to just make sure everyone's happy and safe. Enjoy your summer, and you'll see us in a few weeks. Okay? Bye, everybody.